As the trading session unfolds, shares of SoFi Technologies, trading under the ticker SOFI, are currently priced at $26.77. This represents a significant intraday decline of 4.50%, or a drop of $1.26 per share. While many onlookers see a high-growth fintech name simply caught in a downdraft, the mechanics of this specific sell-off suggest something more calculated is at play. This isn't just broad market weakness pulling a popular stock down. The price action from the opening bell reveals a methodical, sustained selling pressure that is specifically testing the conviction of long-term SoFi holders. The stock opened at $28.07, well below the previous close of $28.03, and it's failed to mount any significant recovery, instead charting a steady path downwards to a low of $26.66. This pattern indicates the sellers aren't just reacting to a single piece of news, but are actively distributing shares, raising the critical question of whether the institutional sentiment that propelled this stock toward its 52-week high of $30.30 is beginning to fracture. The common perception of SoFi is that of an unassailable disruptor, the quintessential all-in-one financial super app destined to supplant traditional banking. The narrative is powerful and easy to understand. A company that started with student loan refinancing has brilliantly expanded its ecosystem to include personal loans, home mortgages, online brokerage services, automated investing, credit cards, and a high-yield checking and savings account, all unified within a seamless digital interface. The acquisition of its national bank charter was seen as the final critical piece of the puzzle, allowing SoFi to gather low-cost deposits to fund its lending operations, thereby boosting its net interest margins and insulating it from the volatile capital markets that other non-bank lenders depend on. This vertical integration, combined with relentless member growth, has created a compelling story of a company building an impenetrable competitive moat. Investors have largely bought into this vision, accepting a lofty price-to-earnings ratio, which currently stands at 54.27, on the promise of explosive future earnings growth. The expectation is that SoFi is on an unstoppable trajectory, and any dips are merely buying opportunities before the next leg up. However, the reality presented by today's trading activity paints a much more complex and cautionary picture. A 4.50% drop on what appears to be no company-specific negative news is a clear signal that the market's focus is shifting from SoFi's growth story to its valuation and its sensitivity to the macroeconomic environment. A P/E ratio over 50 places SoFi firmly in the category of growth stocks, and these are precisely the assets that are most vulnerable to fears of rising interest rates and persistent inflation. When the cost of capital goes up, the present value of a company's future earnings goes down, and this mathematical reality forces institutional portfolio managers to reassess their holdings. The steady decline we're observing today isn't panicked retail selling. It has the hallmarks of larger players trimming their positions, perhaps rotating out of high-multiple tech and into more defensive sectors that perform better in a slower economic environment. The previous close was $28.03, and the stock's inability to even approach that level today suggests a clear shift in the supply and demand dynamic. The high of the day at $28.44 was hit very early in the session and was quickly rejected, showing that any attempt at a bounce was met with immediate and overwhelming selling force. This is the market's way of saying that for now, the risk of holding a high valuation name outweighs the potential reward, irrespective of the company's strong fundamental progress. The company itself is structured across three core segments that feed into its synergistic model. The lending segment remains its powerhouse, generating the bulk of its revenue through student, personal, and home loans. The acquisition of the bank charter directly benefits this division by providing a stable, low-cost funding base through member deposits. The second is the technology platform, which includes Galileo, a payment processing and API platform used by many other fintech companies, and Technesis, a cloud-native digital banking platform. This segment is particularly attractive to investors because it offers a diversified, high-margin revenue stream that is less sensitive to credit cycles than direct lending. Finally, the financial services segment is the growth engine for member acquisition. By offering products like SoFi Invest, SoFi Credit Card, and SoFi Money, the company draws users into its ecosystem with the ultimate goal of cross-selling them higher-margin lending products over time. This financial services flywheel is the core operational strategy, and its success is measured by the steady increase in both total members and the number of products each member uses. The business model is sound, but today's market action is a stark reminder that even a great business model can face headwinds when its stock price has gotten ahead of its current earnings reality. Looking ahead over the next 10 trading days, the trajectory of SoFi stock will be dictated by a tense interplay between company-specific execution and overarching market fears. The immediate technical level to watch is the day's low of 2666. If the stock closes below this level and continues to show weakness, it could signal a more profound correction is underway, with the next potential support zones likely found in the $24.50 to $25 range, an area of previous consolidation. Conversely, for any bullish reversal to gain credibility, the stock must first reclaim the $28 level. A close back above that psychological mark would suggest that today's selling was absorbed and that buyers are stepping back in. Over the next 2 weeks, the most significant external catalysts will be macroeconomic data releases. Any reports on inflation, such as the Consumer Price Index or Producer Price Index that come in hotter than expected, will almost certainly put more pressure on SoFi and other growth stocks, as this would reinforce the Federal Reserve's incentive to maintain a hawkish stance on interest rates. Similarly, employment data will be closely scrutinized. A very strong jobs report might be interpreted as inflationary, while a surprisingly weak one could stoke fears of a recession, which would negatively impact loan demand and credit quality. Beyond macro data, any official commentary from Federal Reserve officials could introduce significant volatility. The market will be parsing every word for clues about the future path of monetary policy. For SoFi specifically, investors will also be on high alert for any pre-announcements or analyst rating changes. Given the recent run-up in the stock price, a downgrade from a prominent Wall Street firm could easily exacerbate the selling pressure we're seeing today. On the other hand, an unexpected upgrade or a positive business update from the company itself, perhaps highlighting accelerating deposit growth or strong performance in its technology platform segment, could be the catalyst needed to reverse the current negative sentiment. The student loan business remains a key variable. While the federal payment pause has been a headwind, its eventual conclusion is expected to be a significant tailwind for SoFi's refinancing business. Any news or policy clarification on that front within the next 10 days could have an outsized impact on the stock's direction. Comment below with your perspective. Do you believe the end of the student loan moratorium will be the single biggest positive catalyst for SoFi in the coming year? In conclusion, the current situation with SoFi Technologies is a classic example of a powerful long-term narrative colliding with short-term market realities. The expectation, fueled by the company's impressive growth and strategic acquisitions, is one of continued dominance in market share capture in the financial technology space. The reality, however, as demonstrated by today's 4.50% price decline, is that the stock's high valuation makes it exceedingly sensitive to the macroeconomic climate. The market is currently prioritizing certainty and value over speculative growth, and SoFi is being repriced accordingly. The next 10 days will be a critical test for the stock. It will reveal whether this is simply a healthy consolidation within the larger uptrend, allowing the stock to build a base for its next move higher, or the beginning of a more painful correction where the stock's price is forced to come back down to earth to better align with its fundamental earnings power in a higher interest rate world. The answer will depend not just on SoFi's own performance, but on the broader economic currents that are now steering the market.